Alright, thank you for tuning in to this edition of the Black Ops Trading tutorial. In our last video, we discussed the buy side of the Armageddon sheet. Excuse me. Now today we're going to take a look at the sell side of the sheet. You'll notice that when you get the sheet, all you have to do is scroll over here from the buy side to the sell side. Okay. The first thing you'll see on the sell side is your long-term trendline resistance, which is very key because this shows you exactly where you are in the trend. And the further you are away from this trend line, then the more bearish the market is. Okay, so just keep that in mind. That's very important to know. That's why I put this here so that you can understand and see exactly where you are within a trend, and you can do your own measurements of distance at that point. Alright, so the first thing you look at is your long-term trend line resistance. The next column is your bear market downtrend. If there is a 1 here, then we're trading below this trend line. It's just that simple. Alright, if there is a 0 here, then the chances are we're probably either in a Kumo cloud of death or it's in a bull trend. You'll know because when you go over here and take a look at your Ichi and Kumo section, if you look across, you'll see here it says bearish Ichi trend. Okay, it's either a bearish or bullish Ichi trend, and your TK lines will be either bullish or bearish. Okay, it's just that simple. So here on the Canadian dollar, using this one as an example, we'll see here that we have a 0 and we have a bullish Ichi trend. So this is in a bullish market, okay? And this long-term trendline resistance is actually long-term trendline support. Market's trading above that, okay? Next column here, here's your Kumo resistance and support lines, okay? That hasn't changed. Alright, so this is where you're going to find your Kumo cloud numbers. So you'll know how far you are when you're away trading outside, like below the cloud or above the cloud, where your numbers are. So you know where you need to close it. So like again with the Canadian dollar, if it were in the cloud, it would need to close above the 96.67 or the 96.05 in order to be out or below the cloud. One thing to note with the Kumo cloud is this. On your support and resistance lines, sometimes we have what is called bearish clouds or bullish clouds. It really doesn't matter, but let me just explain it to you because I'm sure you'll get confused. You may see, like in the case of the Canadian dollar, the Kumo support price is higher than the Kumo resistance price. It just means that right now it's a bearish cloud because the support is higher than the resistance. When the resistance price is higher than the support, then it's a bullish Kumo cloud. It doesn't mean that the trend is bullish or bearish. It just means that it's the type of cloud that it is. So that's all that means, okay? So basically, in a situation like this, the 96.67 is really the top of the cloud. The 96.05 is really the bottom of the cloud. Okay, that's all that means. All right. So the bearish TK and the bullish TK. Let me just speak on that just for a moment. A bearish TK line means when the Tekensen line crosses below the Kijkensen line, that's a sign of bearishness. Okay. In a bull market, it's called or referred to as a weak bear trend, if you will. When it's in a bear market and the T line crosses above the K line, it's considered a weak bullish trend. Okay. Now, there are times more often than not when you get a TK cross that actually leads to a new Ichi trend altogether. For example, if prices are trading above the Kumo cloud and you're in a bullish Ichi trend, and that T line crosses below that K line, that usually signifies a retracement in that bull market, and it means that the market now is going to continue to trade below those lines, and those lines start to act as resistance trend lines, and it weighs very heavy on the price action. All right. Now, that doesn't always happen. Sometimes you do have crosses and then the markets reverse. But more often than not, it is a very good indicator of markets that are in a retracement. Okay, and it usually, the way I like to describe it is, in a bull market, that TK cross smacks the price action all the way back down inside the cloud. Okay. All right. So the next lines you see here is your trailing stop and reverse, your volatility alert, your bot checks, all right, crash alerts, and again, here's your 50-50. Okay, and it'll let you know what type of 50-50 roll of the dice play it is, and then here's your trigger to enter the markets short with the 50-50. So pretty much everything that you need is right here. All right, so you don't have to do any guesswork or anything like that, or second guess the analysis or the price triggers. The analysis is pretty raw, meaning that it gives you, it's matter of fact. It's not giving you opinions. It's actually taking the raw price data and telling you specifically exactly where you are in the market. The 50-50 part, or I like to refer to it sometimes as the roll of the dice part, is the part that is more prophetic, if you will. All it's really doing, it's doing what it's designed to do. It's designed to get you into the market without getting hurt, and it's telling you where you can pretty much find your a better chance of winning. Okay, so in other words, in a scenario like this is going to tell you that you have better chances by trading with the trend. So the 50-50 is actually designed to trade with the overall trend in a given market. It's not designed to speculate or counter trend or try to pick tops and bottoms. That's not what it's designed to do. It's designed to continue to sell short until the trend changes. In a bull market, it's designed to keep buying until the trend reverses. So oftentimes, as trend followers, sometimes we continue to stack our positions. We add to our shorts. We add to our longs on the way. And then it gets to a point where you top out. And that last add-on, usually the market will reverse on you on that one. And that's your signal to go ahead and take profit on all your positions and get flat. Not necessarily get short, but get flat and wait for that sell signal. Okay? That's how that works. That's the strategy of the sheet. The sheet is very intelligent because it's taking all the algorithms of the system and putting them into readable format for you here on the spreadsheet. So pretty much everything that can be known in a particular security is already given to you in the price. And that's really all you need. At the end of the day, it's all about price action. Price action, price action, price action. Price action is what pays. That's all you need to know at the end of the day is the price action. It doesn't matter what the economy is doing. It doesn't matter what Ben Bernanke is going to do. It doesn't matter what the president and his cabinet are going to do. The Treasury is going to do. None of that stuff really matters, because at the end of the day, the only thing that pays us is price. And that's what we track. That's what the system tracks. The system tracks the raw price data, nothing else. It doesn't care about all the fundamentals that go into it. You cannot make money on raw fundamentals. It is impossible. Back in the 80s, you could really make a living trading on fundamentals and doing inside information and stuff like that. That doesn't work anymore, because now we've delegated that role of analysis to computers and algorithms. So you're literally competing against robots, okay? And these robots are designed to not only process raw mathematical price data, but these computers are also designed to actually decipher fundamental data. Places like Bloomberg, they actually have a service for the large firms where they can pay to get the Bloomberg news delivered to them in a computer language format so that the algorithms and the systems, the high frequency traders and such, can trade off of that information, and it puts it into a code that the computer can then decipher and read and make trading decisions on it. So an example would be if let's say today was FOMC day and the Fed comes out and they give their their decision, or and let's say the minutes are released or what have you, just using this as an example, and those minutes are delivered to the firms in a format that the computer understands and can read. So, for instance, a phrase or word trigger can be the word recession, okay, followed by yes, we are in, okay, we are in a recession. And let's say the language also says, that the Fed is concerned or worried. That right there can trigger multiple different trading authorizations in any given code. It may mean to sell short, or it could mean even to liquidate the firm's long positions, or at least start scaling back and taking profit on some positions. So that's how that works. So Wall Street is at a huge advantage over the retail speculator or retail trader. All right. Another thing that you're at a disadvantage on is that most of the technical analysis that comes with major chart packages and things like that, these are just, everyone and their mother is using these indicators. They're using those trend lines. They're using those moving averages. They're using all these same tools. So if everyone is using the same tools, it makes it even harder to generate an income on that. So everyone's competing and they're using the same thing. You need to have an edge. You need to have an advantage if you're going to be a winner and be a repeat winner, okay, and win consistently and remain profitable over time. Doing the same thing that everyone else is doing is not going to get you there. It's impossible. So that's why I put together everything that the Wall Street insiders use, I have. So the advantages that the big firms have, I have, because I used to do what they're doing. All right, but now I do it for myself and for my clients. So what I'm using, no one else is using and no one else has. In addition to that, the way that I use certain chart characteristics, other people don't do it my way. For example, the way I give you the Ichimoku analysis. Now, there are people who use that. I'm not the only one who uses that chart analysis tool. However, I am the only one that uses it in a certain way that I use it. Other people don't use it the way that I use it. The Ichi analysis is really a trend following analysis system that's put together to help you read the charts. It doesn't necessarily help you trade the charts or help you to get in and when to get in and how to manage a position per se. It can be used to do that, but most people, just like everything else in life, use those tools and things incorrectly. Okay. Another one good example would be Fibonacci and Elliott Wave. A lot of that is very subjective and can be self-fulfilling prophecies, but people swear by it and use it anyway, and you got a lot of people using it. So when the big firms are also using it, what does that put you? Unless you use it the way that they use it, or know some ins and outs that the masses don't know, then you're not going to be at an advantage. Because people always ask me, are you ever wrong? Do you ever lose? And the answer is, of course. But it is a rarity. It's more often I'm not losing, I'm winning, and that's because of a few things. One thing is I use strict money management, and that is what really will do it. And we'll go over some of that also in our next video, but we're out of time for this one. So until then, remember, take what you can, give nothing back.